Welcome. Today we're doing a deep dive into the potential disruption of the international trade order, specifically looking at Donald Trump's approach through the lens of Professor Dr. Werner Sinn's analysis.
Our source material is primarily from a transcript of Professor Sinn's commentary, likely from one of his video analyses.
And our goal here is to really understand the arguments Professor Sinn makes, what he sees as the potential consequences, and maybe the underlying factors driving these possible shifts in global trade.
Sinn starts with Trump's stance on NATO. He interprets the questioning of commitments as potentially signaling an end to, well, Pax Americana, that post-World War II era of U.S. dominance.
He connects this to the treatment of Zelensky in Ukraine, suggesting security guarantees might become less reliable.
That's Sinn's reading. He also highlights Trump's quite strong language accusing Europe of taking unfair advantage of the U.S.
And then there are the tariffs. Sinn views this as a direct attack on free trade principles.
Principles, which, he stresses, should operate without these kinds of transaction taxes. Trump's quotes are illustrative here. Sinn points to things like, "You didn't pay, you're delinquent. No, I would not protect you."
Also comments like, "The EU is foreign to screw the United States."
And even calling tariff his favorite or most beautiful word, it paints a clear picture of the perspective Sinn is analyzing.
Sinn then breaks down the U.S.'s main trade partners.
He mentions Mexico and Canada are top partners, but notes they often function as transit points for goods moving elsewhere.
So, functionally, China emerges as a key independent partner.
Followed by Germany and Japan. Switzerland gets a mention, too, in Sinn's analysis.
Now, about these tariffs, Trump claimed very high tariffs from others, right? Sinn references those claims.
Yes, Sinn quotes the figures Trump used, like 67% for China, 61% for Switzerland, 39% for the EU, and then he contrasts them.
Contrast them with the actual WTO average tariffs, which are much lower.
Considerably lower. According to Sinn's sources, 1.7% for Switzerland, 2.7% for the EU on average. He does acknowledge non-tariff barriers exist.
And this U.S. model for calculating tariffs based on trade imbalances.
Sinn discusses that. It's a methodology he seems to find economically questionable, arguing imbalances are more about savings and investment flows.
He gives the French car levies as an example, the malus écologique.
The malus écologique and the malus au poids, yes. Sinn presents these as examples of non-tariff barriers that do effectively hinder U.S. exports despite low official tariffs, and notes this is something Trump points to as justification.
Sinn also looks back, drawing historical parallels. He starts with William McKinley around 1900.
Right, but he emphasizes the context was vastly different. Tariffs were the main source of state income then, and government was, well, much smaller.
The more concerning parallel for Sinn seems to be the Smoot-Hawley tariffs of 1930.
Definitely. There's a strong historical consensus, which Sinn acknowledges that those tariffs significantly worsened the Great Depression.
Global trade and GDP collapsed.
Exactly. And Sinn also brings up the competitive currency devaluations and the abandonment of the gold standard from that era, suggesting they might hold lessons or perhaps warnings for today.
Turning to the more recent situation, Sinn details the tariff conflict with China under Trump.
He outlines the initial tariffs, China's retaliation around 34% initially, then Trump's escalations up to 125% on some goods.
And China responding in kind, up to 84%.
Sinn also mentions Trump temporarily reducing some reciprocal tariffs for countries other than China down to 10%, which carried an implicit threat.
What about the broader U.S. economic picture at the time Sinn was analyzing this?
He references an Atlanta Fed forecast that, at that specific point, was indicating a potential slowdown, possibly even a recession.
And Sinn appears to link Trump's trade policies to that outlook.
He suggests a connection, yes, that these policies could be contributing to economic headwinds.
Sinn also delves into the rationale Trump offered for these policies.
He quotes Trump's rhetoric claims about stolen jobs, factories being ransacked, the American dream under attack by foreign actors.
And Sinn identifies an underlying economic model in this rhetoric.
A model where exports are good, imports are bad. Sinn argues this contradicts basic economic principles.
The standard view being that imports raise living standards and exports are the means to pay for those imports, driven by specialization.
Precisely. Sinn also touches upon Mancur-Olson's theories about domestic lobbying, how concentrated interests pushing for protectionism can often outweigh the broader public interest.
Though he does concede the theoretical point about large countries potentially gaining from tariffs through market power.
Yes, the monopsony idea, large buyer influencing prices. But he considers its practical relevance quite limited, using Switzerland as a contrasting example of a small country.
Then Sinn discusses what he calls the true argument, which he attributes to officials like Stephen Mnuchin.
This argument revolves around the U.S. dollar being the world's reserve currency.
The idea being that providing this currency is a burden.
That's the argument Sinn presents, that this role leads to an overvalued dollar, which harms U.S. manufacturing competitiveness, and that manufacturing base is seen as a security issue for wartime.
But Sinn critiques this burden idea, doesn't he? He mentions the exorbitant privilege.
He does. He questions the narrative that the U.S. is merely providing a service. Instead, he points to the benefits, the ability to finance deficits with easily issued debt, essentially living on borrowed money and potentially inflating away some debt.
He highlights the large U.S. current account deficits and growing net foreign debt,
which reached around 26 trillion USD in his analysis. Plus, the twin deficits government budget and private sector imbalances.
This leads to concerns about U.S. debt sustainability. Sinn notes the debt-to-GDP ratio.
Around 122% of GDP in 6 years, comparing it to Eurozone levels.
Mm-hmm.
He also points to rising interest payments becoming a larger chunk of the U.S. budget, 11%.
And he mentions some rather drastic potential countermeasures that were apparently discussed,
such as forcing holders of short-term treasury bills into long-term low-interest bonds or imposing fees on interest payments. Measures rating agencies might view as distressed exchanges or defaults.
He even mentions past rumors about Trump considering national bankruptcy.
Sinn floats the idea that perhaps the whole trade dispute is, in part, a smokescreen, a way to gain leverage over other countries regarding defense spending, energy purchases, or even seeking some form of implicit debt relief.
Shifting focus, what does Sinn see as the impact on Germany?
Significant vulnerability. The U.S. is Germany's largest single export market, about 10%. The German auto industry is particularly exposed.
Exposed not just to potential U.S. tariffs, but also EU policies.
Yes. Sinn points to EU regulations on emissions pushing effectively towards phasing out combustion engines, hitting German car makers hard. He also mentions French policies favoring EVs that disadvantage German exports like SUVs.
Combined with high energy costs in Germany and declining auto production there.
And Trump's explicit aim, as Sinn quotes, to bring factories and jobs back to the U.S., even urging German companies to relocate. Sinn notes there was evidence of German auto investment shifting stateside during Trump's first term.
How did markets react to these developments, according to Sinn's analysis?
He describes significant investor concern, particularly citing the treatment of Zelensky as a moment that spooked markets.
Leading to capital flight from the U.S.
Yes. Sinn details sharp drops in major indices, DAX, S&P 500, even Shanghai. A clear flight to liquidity towards safer assets.
He draws some historical comparisons for these market reactions.
He compares the trajectory to past crises like the Gründerkrise, Lehman, COVID, but finds the pattern most reminiscent of the lead-up to the Great Depression, a concerning parallel in his view.
What about the dollar's exchange rate during this period?
Sinn notes an initial strengthening after Trump's election, but then a decline, particularly after the Zelensky incident he references, a general weakening trend.
He touches on purchasing power parity, but dismisses the Mar-a-Lago agreement theory for the dollar's moves.
Instead, he outlines the conflicting forces. Tariffs and production relocation tend to strengthen a currency, theoretically. But chaos, loss of confidence, capital flight, expectations of lower interest rates, those all push it down.
He also flags the risk of reciprocal asset freezes or expropriations between the U.S. and China.
And mentions potential pressure on the Federal Reserve's independence, alongside China's efforts to build an alternative payment system. The renminbi blockchain initiative potentially challenging dollar dominance long-term.
Sinn then turns back to Europe, specifically Germany's fiscal policy shift.
He notes Germany amended its constitution to allow significant debt-financed spending initially earmarked for defense.
But with potential flexibility to use it elsewhere, infrastructure, green tech.
That potential exists. Sinn discusses the scale of this borrowing and its implications for the Eurosystem rising German bond yields, Germany moving towards the higher debt group within the Eurozone,
which carries inflation risks for Germany itself.
Potentially leading to relative price increases within the Eurozone, somewhat like Spain before the 2008 crisis, though the context is different. But Sinn sees an unexpected upside.
An upside to Germany taking on more debt.
In the face of potential trade disruptions from the U.S., this debt capacity allows Germany, and perhaps Europe, to enact a Keynesian-style response, stimulating the economy through productive investment in R&D, infrastructure, and defense.
Finally, Sinn makes a broader argument about European integration.
He argues quite strongly that individual European nations are simply too small to effectively deal with global powers like Russia, China, or a Trump-led U.S.-Europe, risks being sidelined,
Especially if U.S. security guarantees become unreliable.
which leads Sinn to advocate for a true political union. A United States of Europe with a single government, parliament, and crucially, a unified army, a federal state.
He recalls past efforts, the success of the economic community, but the failures of defense integration and Cole's push for political union.
Pointing out that Europe created an economic and monetary union, the euro, without the political foundation, leading to current vulnerabilities, like the lack of a common military force.
So for Sinn, forming a genuine United States of Europe isn't just an option, it's become a necessity given the global landscape.
That's his concluding argument, an urgent call for deeper European integration in response to these geopolitical shifts.
That brings us to the end of this deep dive into Professor Sinn's perspective on Trump, trade, and the potential future of the international order. The core takeaways really center on the profound risks he identifies, the complex economic arguments involved, and his strong call for a more unified Europe.
It certainly leaves us with a lot to consider about the stability of the current global system.
Indeed. And perhaps a final thought for our listeners. Reflecting on Sinn's analysis and these potential shifts, what fundamental changes might be needed in global governance and economic structures to foster greater stability and prosperity in the years ahead?